If you like what you see, if I can please request you to subscribe to my channel. So what is dividend yield? A dividend yield is a financial ratio. It is the ratio of a company's annual dividend payments to its current share price. It is generally expressed as a percentage and shows how much a company is paying out each year as compared to its share price. So what is the best way to understand dividend yield? Dividends are derived from the company's profits and are payments made by corporations to shareholders. Let's assume the dividend is not raised or lowered. The dividend yield will rise when the stock price falls. Conversely, it will fall when the stock price rises. It is important to be cautious since dividend yield can look artificially high for companies whose stock price is falling quickly. On an average, a dividend yield less than 4% is considered safe. Higher percentages certainly increase the risk. So which companies pay dividends, and what are some of the advantages and disadvantages of these dividends? Generally, mature companies that are not growing very quickly are the ones that pay the highest dividend yields. A company's ability to consistently pay and increase dividends is a strong indicator of the financial health of the company. A stable or growing dividend yield is a signal that the company is in good financial standing. It also boosts shareholder confidence. It shows that the management knows what to do with the company's future earning potential and does not need this cash for future success. However, on the flip side, the money paid out by the company is now not available for future growth. The dividend can also be eliminated when the company faces challenging times. Another important consideration to keep in mind is how a dividend is taxed. This tax can vary drastically based on jurisdiction. In some jurisdictions, qualified dividends are taxed at a lower rate compared to non-qualified dividends. But what about dividend yields and inflation? Dividend yields can serve as an effective hedge against inflation. However, dividend payments must also increase. A stable dividend is in fact not favorable during inflationary periods since purchasing power is eroded. So what's the final verdict? Well, stocks pay dividends to reward shareholders. High-yielding dividend stocks can be a good buy. However, every investment needs to be looked at in a holistic manner. A higher dividend could also signal a lower stock price or that the management is not using this cash for the future growth in the company. In short, I would say it's a useful metric, but it needs to be used in conjunction with other factors like company health, growth potential, and risk. So my question for the day is, what is the Robert Shiller CAPE ratio?